Mike and Tom are registered with Stewart Partners Global Advisory LLC.
Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom. Welcome back to another edition of Common Sense Finance. I'm Tom Farrell. This is Mike Wiginton. And today we're going to talk about the math of the stock market. You know, over time, the market has always gone up. So if you go all the way back to the beginning when we started tracking the stock market, it's always gone up. Now, there have been times in between where, you know, we've hit some bumpy patches. But Mike, what makes you think the market always goes up, and what are some of the things that you see going on today?
Well, first of all, I'm an avid believer, as I know you are, investing in the market for folks that are looking to grow their wealth and have we refer to folks having the ability and the willingness to handle the ups and downs in the stock market, their financial circumstances right, and they're looking to grow their wealth over longer periods of time. And when we start talking about longer periods of time, we certainly refer into things 5 years and beyond anyway. Right. So here's the thing. We're going to throw up a chart of the S&P 500, which is an index that we use to represent the stock market. And you're going to see that the S&P 500 began its career in 1928. Okay, and we brought it up through yesterday, as a matter of fact. And you can see this. And by the way, going over that long period of time, especially in the early years, it flattens out and it's hard to see. You don't see much of the detail. But we're happy for anyone that wants to send to you a graph, and that's off of our Bloomberg terminal. We're happy to send you a blown up section, a magnified section of any period of time. You name it, 30s, 40s, today, whatever period of time you want to see the detail. But this chart that the old adage that the market climbs a wall of worry, that's what that adage is based on. That you go through periods of war and rumors of war and oil price shocks. Shortages, inflation, high interest rates, and you see that there's always some worry going on and kind of relevant for what's happening today. And that in spite of all this, that over time you certainly have bumps and setbacks, but the market continues to go up. And I want to talk about, why exactly that is. But I know you've been around the stock market for a long time. Certainly you've heard some of those old sayings.
Absolutely. But, there's a lot of reasons why the market continues to go up, but talk about two or three of those main things that drive the market going forward or have driven the market in the past.
Okay, well, and you always accuse me, rightfully so, of getting off in the woods or going off on tangents, and so I want to simplify this.
That's why I said two or three.
I know, simplify this as much as I can. But so here's an example that I use on a regular basis. Understanding that stock prices are based on profits, and more specifically, the expectation of future profits. And so I say, hey, you and I have agreed that we're going to buy one of two businesses. And we've identified those two businesses. And let's just say, for purposes of this example, all other things being equal, so they're in the same industry, they both have $1 million a year in revenues, but one brings $50,000 a year to the bottom line. That's net profit after tax. And the other, again, $1 million in revenues, but it brings $100,000 in profits, net profit after tax. Obviously, we're going to pay more for the one. If we expect those numbers to continue, we're going to be willing to pay more, can pay more. You can justify paying more for the one that makes $100,000 a year.
That company's going to be worth more than that.
It's going to be worth more. And I think that's very straightforward to the point of almost being silly, but it proves a larger point. Stock prices, whether they're private companies or whether they're publicly traded companies, are based on expectation of future profits. Right. you can go back to one of the great books, Security Analysis by Benjamin Graham, that you hear guys like Warren Buffett talk about all the time. And he refers to a company that's not growing sales in any way other than just the general rate of inflation would justify a price to earnings, a measuring a ratio that we use to measure valuation, that we're going to talk about a little bit later, of 5 to 6 times. So you're going to get, all other things being equal, a company whose revenues grows and profits grow just because of the general level of inflation. Right. So I ask folks, you've heard me, does a Corvette cost the same today as it did in 1965? So there's lots of factors. I ask people, do you think the iPhone 10 was the last advancement in information technology?
Right.
And so innovation, you talked about another of all the factors. Innovation is one of there's several variables that determine profitability, but there's none more powerful than innovation. And I don't know about you, but I don't talk to anybody that doesn't believe that their children or their grandchildren, they all believe that they're going to receive health care, they're going to be educated, they're going to transport, they're going to work all differently than we're doing today. And so just as the 8-track tape went away, unfortunately, and the VCR. Yeah, that's exactly right. So we're going to continue to progress. That's the state of mankind. That's our belief, and why one of the reasons we're avid believers in the stock market. It's going to be higher out in the future than it is today.
Yeah. Well, and one of the things that we talk about a lot in here to clients and prospects as well is, the only way to grow wealth is through ownership, right? So let's talk a little bit about what that means.
Okay. So, when we're going to flip up another graph of the S&P 500 again versus another competing place to put your money, and this time it's going to be an aggregate of U.S. government bonds. Okay.
So it's going to be the stock market,
right? The S&P 500
represented by the S&P 500 versus what people consider to be a safe haven type
of investment, and you're going to look at the differences there, and especially the cumulative returns you're going to see. And again, because this index of government bonds only goes back to 1973, that's when we begin our graph. But if you look at those cumulative returns, you'll notice that the stock market's getting almost 5 times. And that's bringing it up to today. It has a cumulative return of getting close to 5 times that of the government bond index. So here's what I want to point out, is that whether you use the term equity, stocks, ownership, those are synonyms. So ownership, whether it's a business, a private business, a piece of real estate, or Walmart stock, just to use as an example, carries the risk that it could go to zero.
Right.
All right? If you're going to take that kind of risk, you've got to be paid for it. That's what we refer to as a risk premium. All right? So if you didn't make more taking that risk, you wouldn't take it.
Right.
All right? And so this graph that we're putting up, comparing the stock market, in essence, as represented by the S&P 500 versus bonds, is pointed out, the difference in returns pointed out on this graph. Now, we talk about there being 2 types of ownership. You can do it actively or directly, own a business yourself, go buy a duplex, apartment, a office building, or you can do it passively through owning stocks. You can either own the stock market broadly by owning an index like the S&P 500 or the Dow Jones, or you can certainly go out and choose your own stocks like Caterpillar or Walmart, whatever. I just bring those names up not to be specific, right, but just for purposes of example.
Yep. So versus a passive investment, an active investment is you're on it, you're involved, you have to go, you have to hire, fire, do payroll, all that stuff. So you should expect a higher rate of return in that kind of situation, as opposed to a passive where you're earning money while you sleep. You're not having to do anything. You're not actively involved in that. You're just using your capital to invest in a passive kind of way.
That's exactly right, and you absolutely have to earn more money in order to make it worthwhile in that direct business. And quite frankly, you're taking more risk. Keep in mind that if you have a business that you own, and this is just one one easy example, easy to me, is that there's some risk that you're going to be sued.
Yeah.
If you own Walmart stock or Caterpillar stock, pick one. It doesn't matter. I'm just using these as an example. I want to hear from the compliance department about naming names.
Yeah.
But
we're not recommending you buy.
And we're not recommending
necessarily.
anything. And look at the disclaimer scrolling across the bottom. But anyway, you won't be, if Caterpillar sued, you're not going to be sued personally if you own Caterpillar. Okay, so yeah, there's a level of risk that you're taking in direct ownership. Think about anybody that's owned rental property understands the work, the level of risk that they're taking. People don't pay you, and such as that. So yeah, absolutely, you got to earn. Not that everybody is earning the right rate of return. We talk to people about that a lot, about their private investments. What kind of return are you earning? They generally have no model to keep up with that. No private model, but anyway, for sure.
And we talk to small business owners all the time about, hey, if you need to invest in your business, if you have extra cash, then you need to deploy that capital in your business to make sure it's running and you're getting the best return you can for that, and you're setting yourself up to grow for the future. But if you have assets that you're not using to fund your business, then you need to make those assets productive, and possibly, depending on their situation, of stock ownership of some form or fashion is the way to go there. So
yeah, something we would recommend them absolutely looking into.
Yeah. So talking about stock ownership, what are some things that you do to when you're looking at a stock to value that stock, to determine, hey, what's a fair price to pay for that particular stock?
Okay, so we talked about some of the math of the stock market that kind of pushes stock prices, that have the tendency to push stock prices higher over time, and now we're talking about some of the math that's involved in how you measure. In this case, we're going to talk about the price to earnings ratio, and I chose price to earnings ratio, by the way, not because there's anything special about it, because there's lots of different metrics that we use, but it's one that we get questions about on a regular basis. I see this PE ratio, price to earnings ratio, but Matt's going to put up the formula on the screen for the price to earnings ratio. It's pretty straightforward, but we're going to do it anyway. But they say, what is this? I keep hearing about it. Why is it worthwhile? And I tell folks, if you've ever bought a home, and again, you are having to generally people are looking for homes in a particular area of town. They're looking for a particular square footage with particular amenities. I want a garage, a 2-car garage, or a 3-car garage. I want granite, or I want hardwood floors. So keeping all of those competing homes the same and the same sort of profile, how we measure whether it's pricey or whether it's a good deal or whether it's just a fair deal, they use price per square foot. This home's selling at this price per square foot. And if it's just like all the other ones that you're looking at, that's how you would use to measure one from the other in terms of what you're paying. Price to earnings ratio is that kind of metric, is that kind of valuation tool. It's used, again, if all the other facets of the other stocks that you're looking at, all the other positions are the same, is it pricey? Is it cheap? Is it a good deal? So that's why we use price to earnings ratio.
And it's not the only thing, but that's
For
probably,
sure.
If you're the first thing you want to look at, maybe that's a good starting point. And then you, depending on what industry you're looking at, the what type of company, whether it's a cash cow type company that's paying a dividend, or it's a growth company. So
that's correct.
That's a good place to start, and then you move on from there.
And that's a good point, because there are other industries like the real estate investment trust, so-called REITs, that don't even use PEs. They use another cash flow metrics. But like we say, this is just one that we choose that we get at questions about, just to address that.
Yeah. Well, and that moves on to the next thing is, the stock market is constantly reacting, trying to get price discovery, get the price right based on the information it has at that point. But talking about the stock market as it relates to the overall economy, it's a leading indicator.
Yes.
Explain a little bit about what that means.
For sure, and this is something that a lot of people have trouble with, especially folks that consider themselves knowledgeable financially, let's say. Although I personally would question whether they are that knowledgeable or not, but they have a lot of trouble with this. And by the way, I tell people, this is the reason that I say to folks that own businesses, even if you don't own any stocks, you have no money in the stock market, and don't ever intend to, it would pay you to understand what the stock market truly is. It's what we call a forward-looking mechanism, and generally, since my entire career around finance, even while I was in school, it's referred to as looking in a 6 to 12 month type of horizon out, looking out and trying to come up with what is going to be, and that means what is going to be with profitability of companies, and of course, for most industries, that starts with what are economic conditions going to be like. So that is a central piece in that forecasting equation. Now here's the thing. Here's what causes a lot of people problems, and it shouldn't be, and it shouldn't cause problems. I heard a guy that considered himself to be, I think he considered himself to be an advisor, and he was on a TED Talk nonetheless, okay, no less, and he said it couldn't be a forward-looking mechanism, or it couldn't have to do with the economy, because the stock market in the bottom of the financial crisis in 2009, the stock market turned and was going up. I don't know what would cause problems with that, because it's a forward-looking mechanism. It was looking through the end of the crisis and forecasting, hey, we're here at the bottom, and it turned up, anticipating a recovery, better economic conditions, and better profits.
Right.
I've also heard just recently, again from someone in the financial community, say, well, the stock market's supposed to be this forward-looking indicator. Well, if it is, it's not a very good one, because it certainly didn't get this coronavirus thing right. Well, let me address that, because that's pretty simple from my position, from my perspective, pretty simple as well. In my entire career, in anything I've ever read, anything I've ever studied, in any group of intelligent, well-educated, informed people in finance, in general in finance, I've never heard one person suggest that the stock market was perfect. In fact, what you would hear, most knowledgeable people that I know would suggest there's no such thing as perfect. No one said that the stock market was a perfect indicator, but I will tell you that as far as I'm concerned, and I take all comers on this, that it's the best indicator that the world's ever known, and as far as forward looking, and it's precisely because and I'm speaking globally here, you take a look at all the entities, whether they're individuals, financial firms, hedge funds, insurance companies, mutual funds, pension funds, the list goes on and on and on around the world that are looking at this thing, financial conditions, profitability, and they're trying to get it right for their own selfish self-interest and the self-interest of their clients, the interest of their clients, which feeds back into their own self-interest, and trying to get it right. And so, they've got a vested monetary interest in getting it right. So it's important to them, and they're serious about it. Is another way of saying it. And so, with what that's referred to in our business is the collective wisdom of the market. And what you said, talking about being a leading indicator is an extremely important thing. But when you start talking about lows, we never know until we look back. You don't know at the time that it's a low, and that's something else we're going to talk about in another podcast and how it relates to today's conditions.
Right. Well, good. That's good. Thank you very much, Mike, for that for your insight. And for that, we will wrap it up. If you have any questions about anything we discussed on this podcast, please give us a call or come by and let us know. Thank you.
I just can't believe all the things people say. Controversy. Am I black or white? Am I straight or gay? Controversy. Do I believe in God? Do I believe in me? Controversy. 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 I can't understand.